Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on this August 8th, 2022, wrapping up the week on a Friday. We have had some mixed sort of price action. Obviously, the markets were initially had this massive dump, intraday pre-market dump. And this gap down and dump came on the backs of a way stronger than expected jobs number. So I think the jobs number blew the expectations out of the water by a mere double. So that is substantially not what the markets were looking for. And one of the reasons why good news was originally taken as bad news for the indices is for one simple reason. The Fed is very dependent on the data in the sense that they are going to rely on the labor market before they truly deem this a recession. And the fact that the labor market is a very coincident or lagging indicator, so to speak, there's going to be a lot of pain, in my opinion, in equities and asset valuations by the time their labor market reflects the true economic global recession. So with a strong labor market, it does leave the ability for the Fed to potentially hike a little bit greater into the September meeting. Obviously, August we don't have a meeting, but September we will have an FOMC meeting where now if the next piece of economic data we wait for mid-month is the inflation number. If we have a strong labor number, which we got, and a higher than expected inflation number, which I'm in the camp that it should come down a little bit more, but it's still probably going to be elevated compared to historic levels. So the Fed should start to aggressively continue raising rates, and I think that's what surprised the markets. It did not surprise us because we were expecting a rally in rates. And I'm going to touch base on the US 10-year yield first because I think that's going to be the most important thing that we can discuss. So clearly the market has been watching this topping formation on yields. This head and shoulders did trigger. However, we were not buying this breakdown due to the fact that inflation was still high. The Fed usually pivots pretty quickly, and I think the bond market was getting this wrong initially, which is why we sold our UBT for a profit, and I'm glad we did that because it's now looking likely that yields can push higher. And one of the reasons I was skeptical about this topping formation is simply the fact that inflation is still very high. It has not come down, and the labor market is strong. Obviously, even if we got a weaker number, that weaker number wouldn't have changed. I'm talking about a jobs number. That jobs number wouldn't have changed, I think, the outlook that the Fed is going to be taking. And there's so many people that have been conditioned over the last 40 years, pretty much a whole investment career, that the Federal Reserve is going to continue to bail them out. But I think where people are getting wrong is their timeline. I think people are thinking the Fed is going to pivot a lot sooner than they actually can. And I don't think that they're going to pivot quite yet like the bond market was kind of signaling initially. And as soon as we got this bullish reversal candle, that was my signal over here that I think the bond market is pricing in something wrong and that we will most likely see a negation of this topping formation. And that's certainly what it's looking like to be. You've recaptured the neckline on this daily chart so far. There's an hour left. I doubt you sell off. But the interesting thing is that when you flip on a weekly chart, and which is why I am even a little bit more bullish now on yields to go up a little bit, is for simply on a weekly basis, you are closing above this neckline. So the longer term trends, which you do not have a head and shoulders formation on the weekly chart, and since you have recaptured that neckline on a weekly basis, even on a daily basis, it does favor a move up to at least 3%, potentially 3.1% on the charts. That's kind of what I'm seeing now in yields, and I'm glad we sold our UBT because it does allow us to potentially pick it up at a lower spot once yields do push up. So I think that's kind of what's surprising the markets. And the interesting thing is the markets haven't really clued in. Certainly risk off assets have not clued in with the signal that the potential bond market is giving. A negation in this head and shoulders is truly something to really hold a lot of weight to, because the biggest moves come from failed patterns. So when you have a head and shoulders that triggered and now is potentially failing, the biggest moves often come in the opposite direction. So since this is a failed breakdown move, and typically you would have seen a lot more downside, since this failure of this breakdown is failing, you generally see a stronger move to the upside, which is what I'm favoring for yields. And it does align with the fact that inflation is not yet under control. The Fed needs to really get it under control. So this is the key price action today. Obviously, with a stronger yields, we did have the dollar push up over here. So the dollar is still technically closing inside of this channel of consolidation. We'll just have to see how high the dollar can go, with yields potentially rising more over the next 1 to 2 weeks. The dollar should start to also push up, which will put additional pressure on the overall equity markets. So simply looking at the dollar weekly chart, you can see we're still in sort of an overbought scenario, but we have had 2 weeks, now a third week of consolidation to potentially move higher. And maybe, just maybe, what we can get is some sort of a float up over the coming weeks to test this double top scenario on the dollar. And that would coincide with a move up in yields. So let's take a look at the S&P 500 here, shall we? So flipping to the intraday chart, you can clearly see we're stuck under resistance, this downsloping trend line. We have had a short-term breakout out of this wedge pattern. Just like yesterday, though, this wedge pattern can fail. We're looking for a confirmation candle, which is 3 minutes left on this candle. If you do break out of this wedge, you likely could go up to this 414 level, but that may be a stretch. The thing that's been the saving grace for these markets, in my opinion, if we simply flip to the daily chart, let me just erase some of these lines so it's easier to see. But if we simply look at the daily chart, you are consolidating in this range, just like you were over here. And the interesting, what caused this collapse and sell-off was a surprise interest rate hike by the Bank of Switzerland. So in theory, could we be replicating what happened here, except it's not going to be the Bank of Switzerland. It could just be potentially the Federal Reserve and the bond market signaling a likelier, more aggressive Fed, since the labor market is so strong. And the labor market is kind of doesn't really show the full picture, because the data that the Federal Reserve is going off of, in the sense that payrolls are strong, unemployment's low, it isn't really reflecting the 3.6 million jobs that are lacking from the labor participation rate. There are currently 3.6 million people that are not wanting to return to work. So there's a plethora of jobs, which ultimately puts a damper on the amount of production as a whole that we can produce as a country. So that is never a good thing for inflation. It's never a good thing for economic productivity, because certainly with a high labor participation rate, certainly a low labor participation rate, it puts a lot of strain on the overall economic growth, since a lot of people are content with either just staying at home, living at home, working from home. And overall, I do think the economy is going still through a transition that equity risk assets are not quite pricing in yet. So if we simply look at the intraday candle in the S&P 500, your initial gap down on the jobs number, and then you had a massive rally, a surge. You failed to take out the high. You had another sell-off down below. And notice how you're making a series of higher lows over here, but lower highs over here. So this is a standard wedge formation. It does favor a break down to the downside. And ultimately, I think your first level of support is still going to be this technical gap fill around here, around this 408 level. So I do think the markets have to push down to fill that key technical gap. Overall, we'll just have to continue to monitor the price action. I think the Qs were the weaker of the indices today. They were down a lot more, but they're just slightly down, just a little bit less than a 1%, but down on the day nonetheless. The Qs are still holding this bullish consolidation, but if we get a move up in rates, I think the risk assets will certainly price that in. If we simply look at things like Tesla that require a lot of debt to funding, Tesla is not giving good signals. This is a failed bullish consolidation pattern. You have now failed this level, and it does look like if Tesla is any leading indicator for the assets to come next week, I think we see more downside. Tesla is down 6.63% on the day. And the interesting thing about Tesla is when you flip to a weekly candle, you're actually putting in this weekly reversal signal on volume. So that is key to understand and know. I think Tesla is going to be the leading indicator because you have so many Tesla bulls. Tesla people are so passionate about owning the stock. If you start seeing sentiment change in Tesla, that is typically never a good sign for the risk assets in the equity market. So overall, that is healthy for our short to see a beautiful down day. It's a nice reversal candle right off of these parallels. If we flip to the daily chart, you can see we're watching this parallel over here, pivots action over here to pivot, and look at this beautiful daily topping tail that you got, and you never ever managed to close above that topping tail initially, and you had 1, 2, 3, 4 more days of price action, and finally this failure. And the weekly chart is demonstrating that you're now closing below the weekly 50-day moving average. So I think that is short-term bearish, and you have to use Tesla as a guide to, I think, what is coming for the rest of the market. So if we simply take a look at oil, WTI initially had a bounce in the day, but it's starting to fade. You are still slightly up on the day, just up under 1%. So pretty much a flat session there. Considering oil was up 1 to 2% in earlier session, it's never a good sign to see oil continuing to reverse and reverse and reverse. You are at support, so it still does favor a potential bounce maybe to this 93 level. But again, the markets are kind of on borrowed time. If we look at natural gas is just kind of consolidating and flagging over here. In a way, I still think natural gas can potentially move up, which is why I haven't started short. But overall, if the markets start deteriorating quicker, then energies will likely be hit. Nonetheless, this still is a nasty topping formation that is in play for natural gas. I still think the longer term outlook for natural gas is probably around this $3 level, 368 level, and then we'll have to reassess at that point. But it's certainly interesting price action across the yields and bond markets today. Let's take a look at gold. Gold initially had a nasty sell-off, but it did manage to bounce off a little bit off the lows. So it hasn't negated this completely bullish candle which we got yesterday, which is a really good thing considering the dollar is substantially up on the day along with yields. So what I'm potentially wanting to see now on the dollar, or sorry, on gold, is yet again another consolidation channel in and around this range over here that we could potentially see it flag sideways for maybe another week or two before pushing up and testing this big 1808 resistance level. So that's kind of the targets for gold. I think we need another week or two of consolidation before the next push up in gold. If we take a look at silver, similar price action, had an initial dump. It is rallying and recapturing half the gains that it did lose. So a similar thing to silver is we could be seeing this little bit of a bull flag pattern starting like this, where silver could start to consolidate in a little bit of a lower range before ending up breaking out and testing this 2075 resistance or 2070 resistance. Let's take a look at the Russell IWM. IWM has actually been, on a relative strength basis, it has been the strongest. So if you look at the IWM is coming up into major resistance as well. You filled this gap. You do have a slight technical gap fill up here. I got to think the markets are wanting to go up to this double gap zone. The interesting thing is it's a rare phenomenon to see where you have a gap here and a gap here. So it's a double gap, almost as if the markets are going to be pulled in that direction until that gap is filled. I think that's kind of where the Russell has to really start looking towards. If we just take a look at the SPY just to see how it finished on the day, so around 413. So the S&P 500 did close negative on the day, as opposed to the Russell, which signifies the small caps, was positive on the day. But nonetheless, these markets are extended. I do think some sort of a pullback is very necessary in the short term in order for these markets to either continue to consolidate and move higher, but I do think they're on borrowed time, and it's only a matter of time before some sort of a catalyst appears in the news to knock investor sentiment down. And the sentiment around this market has been, since we've rallied substantially off the lows, I mean, if we just look at the S&P 500 here, we've had a almost perfect move compared to this low to this here, compared to this low to this low. So we've had a measured move. The markets have rallied. You're into tons of resistance. Yields are rising. The economy is working. PMIs are decreasing. Again, the factors, when you stack it up, are not in favor of this market to continue to trend higher. Now, that being said, things always tend to surprise you, but I do think the markets will see that next down leg sooner rather than later. Let me just touch base to see if there's anything else. We can take a look at Bitcoin. Bitcoin's price action over here is pretty weak in my opinion. You do have a little bit of this bullish consolidation, but this is kind of make or break for Bitcoin. Bitcoin is still been under pressure. You can see it tried rallying up here and it could not hold on to those gains around 23,444, and it's now closed back below 23,000. So it'll be interesting to see where Bitcoin trades over the weekend. I do think that since the markets are extremely light volume, there's not much liquidity in the markets, that we could potentially see Bitcoin float up to test the upper range here around 25 before the inevitable pullback in Bitcoin comes along. I think that's it for today. We did close a winner on our XLF trade. Typically the banks will rise on interest rates, but again, I'm not really liking the fact that the banks have been really struggling around this area. And even with the surge in interest rates, banks really didn't react that well. So it does point to potentially some underlying contagion issues across our credit and debt markets that the banks may have exposure to, which puts them at risk. So I just wanted to close this winner for almost a double-digit gain, 9.4%. And we'll just have to continue to monitor financials and the rest of the sectors. That being said, hopefully everybody has a great weekend. It was another profitable week for us here at Trading Capital. So congratulations if you caught a few trades with us this week. We'll continue to monitor the charts as we head into Monday. Again, we'll have to reassess and monitor the economic data that comes out. So far, markets have had an amazing move off the lows, and I do think that they are very susceptible to any sort of bad news event that may be lurking on the horizon. Take care, everybody. Please give this video a big